The difference between a 2-year and a 10-year yield right now, negative 85 basis points. The biggest spread, the most deeply inverted yield curve we've seen going back to the early 1980s. Equity futures still elevated on the S&P, up 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, President Biden expects the U.S. to avoid recession. Credit Suisse flagging substantial losses in 2023. And Disney cutting 7,000 jobs as Bob Iger looks for savings. We begin with the big issue. Corporate discipline returns.
Obviously, you're seeing some margin pressure here.
The recent layoffs.
You've seen the cost cutting.
As companies are trying to figure out, how do I manage my balance sheet?
Companies are going to lay off workers when there's margin pressure.
They're focusing on the cost cutting.
Look, they're doing what they need to do to maintain profitability.
The Band-Aid ripped off.
The primary lever that they have to pull to defend their margins is reducing their labor footprint by reducing their employee expenses.
Protect free cash flow.
What I see is just broad-based margin pressure.
Margin pressures are going to be a significant headwind.
The cost cuts can only get you so far.
This is all about execution now.
Two key words right now, disconnect and discipline. Kroll's Megan Green joins us. Jim Bianco of Bianco Research. Megan, first to you. Let's talk about a disconnect. Do you see a disconnect at the moment between what you hear from the C-suite in America and what you see in the economic data?
Yeah, absolutely. Clearly, with the last jobs data being so incredibly strong, there's also a disconnect with headlines, right? We hear a lot about layoffs in the media, but it's not particularly broadly based. I do agree, though, that it could turn on a dime. So I do think that the labor market has held up so well, in part because there is a lot of labor hoarding. We don't really know how to measure it, right? It's anecdata more than anything else, but we do know that it's happening. And so it is possible that as corporate earnings fall because rates continue to go up, companies decide they're not going to hang on to those workers until the other side of this. They may capitulate, lay people off, and then I think we would get a broad-based downturn. In fact, that's what I think would push us into a recession, even more so than, household savings being whittled down. If people start losing their jobs or their friends start losing their jobs, that's when they really retrench, and consumption is about 70% of our GDP. So I think that would be the real spark. It's just impossible to guess when it might actually happen because we haven't gone through this kind of labor hoarding before.
Looking at the numbers for jobless claims, and that's where you'd look for signs of weakness. 196,000 is the print. Just to come to you on that, Jim Bianco, that's the first pickup in about 6 weeks, but still, sub 200K. There's some pretty stellar numbers, aren't they?
Yeah, those numbers are very good. You would not associate any kind of a slowdown or recession with the claims numbers being that low. And as far as the layoffs go, for right now, the layoffs are really concentrated in tech and other high growth industries. After last year, I think a lot of these companies are being told it's time now that you start showing profitability or a path to profitability, and you just can't keep hiring people and losing money or not making a whole lot of money and promising us that down the road, many years from now, you will make money. We want to see it now. And keep in mind, too, with a lot of the layoffs that we're seeing, these are announcements, and we're going to lay off 7,000 people at Disney, but that could be through attrition. It could take a couple of years. It's not going to happen all in 1 month. And so this will not really show up as some big giant spurt in the claims numbers.
So, Jim, that's good news for some of these equities, and maybe Meta, Facebook's a decent example of that. Discipline returns, the stock rallies. Lisa Shallard of Morgan Stanley said there was a massive disconnect in this equity market. She said history is not kind to these kinds of massive disconnects. Can you relate to that?
Yes, I can, because when you see the market switch on a dime and tell companies that we're high growth companies, don't worry about your profitability or your margins right now. We want to see big growth in the future. And now we're going to turn and say, okay, you need a new business plan. You need to start making money right away. That's easy to say. That's almost impossible for a lot of these companies to do. The managers, the culture has always been about trying to figure out a way to make money in 5 years or in 10 years, not to make money in the next 3 or 4 quarters. So it's going to be quite an adjustment for some of these companies.
The other disconnect might be what's developing in the bond market and what's happening in equities right now. We've got a 2-year, 10-year spread at negative 85 basis points. As I mentioned at the top of the show, that is the widest spread, the most deeply inverted yield curve going back to the early 1980s. Megan Green, what kind of signal can you take away from what's happening in the bond market right now?
Yeah, I mean, a yield curve is an indicator that a recession is coming, but it doesn't give us any indication of what the choreography is, what the timing is, how deep it is. So just because the yield curve is even more inverted now, I wouldn't take that much from that. I think a better indication actually is the labor market. It's a better indicator than any economist or the yield curve in terms of predicting a recession. If we see a jump in unemployment of a certain amount over a certain period, that's the best indicator for a recession. And as we've just mentioned, we're not seeing that. We're not seeing a deterioration in the labor market. And so, you know, the chances of a recession have gone down a little bit. That being said, I think we will see it as the Fed continues to ratchet up rates and also continues to shrink its balance sheet, which most people have kind of forgotten is happening in the background. But that is a significant tightening as well. So I wouldn't worry so much about the yield curve. I would worry more about the labor market.
We have hardly talked about QT. They wanted it to operate in the background, and maybe that's the way it's going, at least for now. Jim, I've always thought that if I'm willing to accept a yield that is 85 basis points lower on a bond with a maturity that is 8 years longer, that there must be some kind of signal the market's sending to me. What kind of signal is it sending to you?
Well, yeah, I mean, historically, as Megan said, you know, the signal is that a recession or a downturn is coming, and that could still be mid-24. It could be as far as 18 months out in the future. And also, as Megan kind of alluded to, too, is that the more inverted the curve gets doesn't mean the worst recession. It's kind of all the same kind of signal, whether it's 20 basis points or minus 200 basis points. It doesn't signal that it's worse because it's more inverted. It does suggest a broad-based slowdown will be coming. That's what the market is anticipating. But I think what Wall Street's mistake is they think that's March or April. But it might be March or April of 24, or it might be June of 24. And I'm not so sure that Wall Street has the patience to see that the recession is going to maybe unfold a little bit slower and longer than they think.
Well, corporate America's making a move. Disney, the latest, putting their cards on the table. We're looking at 7,000 jobs to go, $5.5 billion in cost savings, and the stock, Katie Lyons, is rallying by 6.5%.
Yeah, investors rewarding this in a huge way, John. It is so interesting to see these companies going from grow, whatever the cost, to shrink your costs as fast as you can. That kind of seems to be how the tide has shifted for corporate America. Now, for Disney in particular, as you said, $5.5 billion in cuts in total. $3 billion of that is coming from slicing their TV and movie budgets. Remember, this is a company that invested billions of dollars into streaming, trying to grow that business during the pandemic. And now Bob Iger is throttling back in a massive way, trying to focus instead on profitability and expanding those margins, because we have not seen Disney's net income keep up with the rebound they've seen in sales, which is what is evidenced by this chart here. And this really is just a case of not trying to be a growth stock like Netflix, which initially was the ambition if you look back a few years ago. And we have seen these growth-oriented companies really across the board making these kind of changes. That's evidenced by the slew of layoff announcements we have gotten from the tech sector, trying to cut costs, capture more profit, because we know companies universally are feeling that margin squeeze. Demand is slowing down in many areas, and costs from labor and beyond still remain elevated. So we have seen that margin contraction happening in the fourth quarter results that we've been getting, about 12.1% on average for S&P 500 companies. They're expected to stay tight in the current period. And yes, there is forecasted fattening to come later on this year, John. But if you do want to expand those margins, you want that to happen, you kind of got to make some changes.
These companies just aren't being rewarded to chase growth, to chase subscribers like they were in the last couple of years. Katie, thank you. They're being rewarded to cut costs, to protect margins. Apollo's Torsten Slock had this to say earlier this week, and we caught up with Apollo's Jim Zelter and talked to him about this market environment. This is what Torsten had to say. From hard landing to a no landing. I want to explore that theme. From hard landing to a no landing, investors have been underperforming their benchmarks because they entered 23 underweight equities, expecting a slowdown that still hasn't happened. Megan, we've talked about a hard landing. You and I have gone over a soft landing a million times. What do you make of this theme, this phrase, no landing?
Yeah, so I mean, I think what he means by that is just, significant amounts of uncertainty. So as Jim alluded to, I think investors have expected a recession to come sooner than later. That was never going to happen given the huge cash cushion among households and corporates in the U.S. economy. So, I think there is a lot of uncertainty. Are we going into recession? Are we not? Have we already been in recession? This is an academic debate that mostly economists care about. I think for most regular people, whether you're growing a little bit or contracting a little bit, it all feels the same. So, I think this idea that we would have any landing at all in the first half of this year was always wrong. We might be in recession in the second half of this year. As I said before, I think that depends entirely on the labor market and also how the Fed responds to the labor market and to inflation. It's possible it's being pushed off a bit further. There's also a scenario where different sectors of the economy go into recession at different times. So it's kind of a rolling recession. So we've already seen it in manufacturing. Maybe we're seeing it in tech. Services will eventually be hit. In a way, that's a great scenario because the overall economy doesn't go into contraction. So we don't have an overall recession, but actually inflation is brought down. So to some degree, that may be what the Fed is actually hoping for. But again, for regular people in those sectors, it's an academic debate. It's still pretty painful for them.
For everyone else trying to follow, it's enough to make your head spin. Julian Emmanuel of Evercore was on the program in the last 24 hours. He said, if you're not confused right now, you're not paying attention. Jim, are you confused?
Well, yeah, I mean, this is a post-COVID economy, as I like to call it. It has different traits and it has different characteristics to anything that we haven't seen before. And the labor market is probably front and center, the most confusing of them all. The data that we see, whether we're talking about claims or payrolls or the 3.4% unemployment or even ISM employment, is confounding people because it's not showing any signs at all that the market is slowing. So that and a lot of other things about labor hoarding, as Megan talked about, that's a new concept that's mostly anecdotal and we're still trying to figure it out. Yeah, it's been very confusing because it's been so unlike anything we've seen before.
A phrase we keep going back to on this program, you can't fire what you couldn't hire. We're still trying to process the post-pandemic realities in the labour market. And then just to make everything even more confusing, China reopening. This is what Evan Brown and Luke Cower have got to say over at UBS. Evidence of economic re-acceleration from US, China and Europe is a more powerful catalyst for markets going forward. Cyclical areas of the equity market have more room to run. That's the equity call from Cower and the team over at UBS with Evan Brown. Megan, your thoughts on this too? It's not just the post-pandemic labour market realities we still need to make sense of, but also the fact China's reopening and what kind of growth impulse will we be importing from China?
Yeah, and I don't think it's just the growth impulse, it's the inflation impulse from China as well. But I would highlight that this reopening for China, this resumption of growth, it will look different than previous ones. In the past, they've been investment driven. So that's driven a lot of demand for capital goods from China's trading partners. This time around, it's consumption driven. And it's less that there's a massive stimulus and more that Chinese authorities have gotten rid of very restrictive policies. So you're not seeing a huge imbalance between supply and demand, I don't think, emerging in the Chinese economy. And again, it's consumption driven, so it will be domestic services driven. So in the past, when China's accelerated, it's really boomed for the rest of us. This time around, I don't think we'll get that kind of boom. I think China will accelerate from around 3% growth last year to over 5% growth this year. It might be mildly inflationary for the rest of us, but we won't get the growth impetus or the inflation boost from China reopening that we've had in previous Chinese booms.
Jim, final word on that.
No, I agree with that. And in fact, if you look at the commodities markets, the idea was when China reopened, they would suck up all these commodities and out the other side would come a burst of finished goods. Well, the commodities markets aren't really responding. It's been now almost 2 months, 2.5 months since the reopening was announced, and we're not seeing booming commodity prices. So as Megan was talking about, it may be more services, but we're not definitely seeing the, some big pull into the process of making a lot of capital goods to go out the other side. So it's very different than I think a lot of people expected just 2 months ago.
Can I just say my new favorite thing is anecdata instead of anecdotal evidence? I just think that's brilliant. Megan, did you make that up?
No, I didn't. I wish.
I think that's brilliant. Where's that from?
I'm not sure. It's just a concept we're using a lot now.
It's yours now.
Because, thank you. But it's the data's weird, and so we're having to rely on sentiment and ideas, and we don't know how to measure that stuff.
Megan, stick with us alongside Jim Bianco. Equity futures right now up 0.75%. Coming up on the program, President Biden throwing the R word out the window.
Do you think there's going to be a recession this year?
No.
That conversation up next.
Just we were told I wasn't going to be able to pass the Inflation Reduction Act or the chip. We passed them all. People don't understandably don't realize all of it passed back in June, July, August, September. It's only coming to fruition now.
Do you think there's going to be a recession this year?
No, or next year. From the moment I got elected, how many of the experts are saying within the next 6 months there's going to be a recession?
President Biden doubling down on his State of the Union address, reiterating his confidence in the U.S. economy and even name-checking Xi.
Can you think of any other world leader who trade places with Xi Jinping? Not a joke. Can you think of any? Who would? I can't think of one. This man has enormous problems. He has also great potential. But so far, he has an economy that's not functioning very well.
China's government didn't like it. The foreign ministry calling the remarks, quote, highly irresponsible and a violation of basic diplomatic protocols. They went on to say, we are firmly opposed to that and condemn it. Bloomberg's Anne-Marie down in D.C. AMH, what do you make of that?
Well, the president is once again, Jonathan, taking aim not directly at China, but at Xi Jinping himself. This is basically a follow-on of what he said at the State of the Union, which was an ad lib. This was something he said off the cuff. It wasn't his prepared remarks saying, name me one leader who wants to trade places with Xi Jinping. And then in this interview, he talks about what he calls, quote, enormous problem Xi Jinping is facing. He looks at the domestic concerns of the economic complex in China right now, coming out of what many are calling a failed COVID-0 policy. What is China facing? Very high unemployment rate when it comes to the youth. They're facing a downturn in the housing market. There's a number of issues this economy is facing, and I think the president is trying to get that across to the American people, because a lot of the times what we see Xi Jinping and the Chinese Communist Party do is placate to nationalists and talk tough on the United States. But Biden's trying to point out that it's not all rainbows and butterflies over there in China.
That's the international story. Let's talk about the domestic issues as well. AMH, the president has been baiting Republicans over one single issue. How have Republicans been responding to it?
Yeah, this is Social Security and this is Medicare, and the president's going to do it once again today, Jonathan, because he is going to Florida. And of course, it is the senator from Florida, Senator Rick Scott, who first put this proposal about potentially sunsetting these entitlement programs. Republicans do not like it because Speaker McCarthy said that he's come out and said that these issues, Social Security and Medicare, are not on the issue. So they are saying that the White House is playing politics with not even, and the president, to his point, the State of the Union said he doesn't even think it's the majority of Republicans, but there are some members who brought this up. So they really want to make sure that they are taking this message to the American people, especially as the president is thinking about when he's going to announce his 2024 run.
Looking forward to it. When are we going to get that announcement? Anytime soon?
Maybe March, maybe April.
Maybe May, maybe June. AMH down in Washington. Anne-Marie, thank you, as always. Megan Green, Jim Bianco back with us. Now, drum roll, please, because every time I do this, people often reply with nothing. You said this, Megan Green, in your latest column in the FT. You said, forget Groundhog Day vibes on the debt ceiling. This time it's different. Why is it different this time?
Look, I think this time is different because we have a very clear destination. We need to lift the debt ceiling and absolutely no clear path to get there. So I actually think the risk of not lifting the debt ceiling is much higher this time. I would put the probability at around 15%, which is shockingly high for such a catastrophic event.
You also said
so
investors
I think it's very different this time.
Sorry, Megan, just to jump in, but you also said that investors must focus on it now. What should they focus on?
They should focus on the risk of a debt default. I mean, the longer investors are sanguine about it and just assume that politicians will stop dithering and figure this out and raise the debt ceiling, the less pressure there is on politicians to do it. You see a lot of glib comments, particularly out of the right wing of the Republican Party, saying, well, it's fine, we can just prioritize Treasury payments. It's not clear we actually can do that, or even that it's legal. There are a lot of things that the Fed might be able to do. Never mind that Jay Powell has called some of those mitigation efforts, loathsome if we have to pull them out. So there's kind of a glib attitude among some of the politicians that we can just, default. It's not a huge deal. And actually, given that, we have the biggest, most liquid asset class in the world, and that the Treasury is a benchmark for a lot of other bonds, it would really roil U.S. and global markets. So I do think it's going to require market discipline to focus minds and get politicians to agree on this. And that's not going to happen as long as investors aren't really worried about it and just assume that we'll end up with a best case scenario.
Jim, do you agree?
I'm going to take the other side of that. I think this is politics as usual. I think as long as the perception is one side loses on this debate, the Republicans, that there'll be a lot of histrionics. And like all politics, when we get to, if June 5th remains the date, it'll be a couple of hours into June 6th when they'll have a deal or something along those lines. But I don't think that right now that there is any heightened concern from investors, nor should there be. You've had Rick Reeder on the show, and he says Wall Street's most concerned about the shark closest to the boat. And this is a shark that's well away from the boat right now. So if we're going to see investor discipline kind of force it on the market, it probably won't happen until late May.
And this is the issue. And I guess this is the essence of your message, Megan, is that the market doesn't really care right now. You see that in the amount of guests that come on this program and say, same story, witnessed this a million times. And ultimately, won't they carry on pushing the issue down in Washington until the market cares?
Yeah, unfortunately, I think that's right. And so this would be the mother of all own goals. I said I think that there's a 15% probability that we won't lift the debt ceiling and we'll have some kind of default, either on our treasuries or on the government's other payment obligations, Social Security, firemen's salaries, soldiers' salaries. Either way, that's a shockingly high probability for such a catastrophic event. We cannot worry about it until all of a sudden it really is a big deal. But I do think it would be better for the markets ultimately if actually investors focused on this now, put some pressure on politicians to go ahead and figure out a deal. I'm not confident that that's going to happen, or I'm not optimistic that that's going to happen. I'm pretty confident that it won't.
Yeah, you don't sound that optimistic at all. Megan Green, thank you, as always. Just brilliant to have you back on the programme alongside the fantastic Jim Bianco there of Bianco Research. Coming up, morning calls, and later, tech giants squaring off as the AI race heats up. It's Google versus Microsoft. Plus, we'll catch up with Canaccord's Tony Dwyer. Equities up 0.8%. Let's get you some morning calls. First up, Roth MKM downgrading DraftKings to sell, expecting upcoming results to show weaker profitability. Barclays upgrading the New York Times to equal weight, seeing potential upside to long-term margins. And finally, KPW downgrading Bank of America to underperform, saying these stock trades at an unwarranted premium to its peers. First stock down 0.4%. Coming up, Canaccord's Tony Dwyer says it's all about recession, looking for a soft landing before getting more aggressive in markets. That conversation still ahead. .23 seconds away from the opening bound this morning. Good morning to you. Equity futures elevated by 0.9% on the S&P. The Nasdaq flying again, up by 1.4%. On equity futures coming into Thursday after the close on Wednesday, down about 0.5%. No real drama. There's your opening bound. Switch up the board and get to the bond market. Yields look a little something like this, down 3 basis points on a 10-year, sub 360, 358 on a 2-year. Started the year, or rather ended the year in 22 at about 442. Your 2-year right now, guess what? 442. Round trip. Euro dollar 107.87, positive 0.7%. The euro showing some strength. German CPI a week late, comes in with a bit of a downside surprise. Whatever you want to read into that, it's come down from 10 to 9. I think the Germans still view that as a problem. Crude right now has had a massive run recently. Brent and WTI put together a 3-day rally worth $5, more than 6% over the previous 3 days. This morning we come lower by about 1.2% to $77.51. About 40 seconds into the session, we advanced 0.9% on the S&P. On the Nasdaq, up by 1.3%. One stock to watch. It's Disney announcing a massive restructuring plan, 7,000 job cuts. The CEO, Bob Iger, saying, we're going to take a really hard look at the cost for everything we make because things in a very competitive world have just simply gotten more expensive. Abby has more. Hey, Abby.
Hey, John. Yeah, and this is one quarterly report where it's less about the numbers and more about the color, of course, from returning CEO Bob Iger. And bottom line, it's all about that restructuring you were talking about. In fact, he said literally it's time for another transformation. So it means this cost cutting, $5.5 billion worth of cost cutting with a $3 billion trim to their movie and TV business. They're also eliminating about 7,000 jobs, many of those coming from a division created by the old CEO, Bob Chapek. In fact, right now we have Bob Iger doing an interview with a competitor talking about the idea that his structure, Chapek's structure, was a mistake, created a huge divide. So he's trying to correct that. As for the actual numbers, earnings did beat 99 cents by beating by 30%. Revenues basically in line. Subscribers, though, not so much. They posted 161.8 million subscribers, missed the mark of 164 with declines in each of the different areas. ESPN is now really a huge priority, but there was a decline there even. Overall, though, John, it really may just be a matter of confidence. This stock down more than 40% over the last 2 years. Bob Iger is back. He's really promising this transformation. One person right now that might be pretty pleased, Nelson Peltz, of course, the activist investors. He's asking for a seat on the board, but he's also asking for cost cutting. So it seems that he and other investors have had that. He also, John, is asking for reinstatement of the dividend. Bob Iger did say he's going to go to the board and ask for the approval of a modest dividend reinstatement. Perhaps that will help that stock turn around. Certainly that's happening today on The Morning.
Abby, thank you. Disney up by 4%. Another sector to watch at the open. Casinos win. MGM results beating estimates as travelers return to Vegas and Macau. The MGM CEO saying there is strong momentum in our business and our 23 outlook remains bright. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, both of these stocks up 6% or more here in the first few minutes of trading after, as you said, they topped expectations. Revenue coming in ahead of estimates. Mind you, they both still reported losses per share. So this is a recovery we're talking about. We aren't fully there yet. But specifically in China, the picture is getting a lot better because remember, Macau, the gambling enclave, made up a huge portion of these companies' revenues pre-pandemic. That meant they really struggled in this market when China was locked down. But with the reopening of China at the tail end of last year, you really saw that recovery taking shape. Wynn's Macau mass table drop, for example, has reached 95% of 2019 levels, hotel occupancy at 96%, and MGM's VIP gaming tripled in the fourth quarter from the level seen the quarter prior. Then the Lunar New Year holiday guidance also coming in quite strong. The daily EBITDA for both of these names during that holiday last month seen in the millions. 4 million for MGM China, 5 million a day for Wynn Macau. So the gamblers are back there in a big way. This is why we have seen a massive rally in these and other Macau casino stocks. We have seen them more than double off their lows of last year. A BI index that tracks these names is up 124% since the end of October. So only a 3.5-month period. Plus, here in the U.S., as you alluded to, John, this isn't just a Macau story. Las Vegas is going strong. One analyst over at Jefferies, when looking at results today, said Las Vegas is starting to sizzle, which sounds pretty fun.
Some of those moves have been phenomenal. Kaylee, that does sound fun. Kaylee Lyons, thank you. Let's turn to tech. The race for AI heating up. Microsoft challenging Google in a massive way. Quote of the week to the Financial Times. Satya Nadella, the CEO of Microsoft, said this: from now on, the gross margin of search is going to drop forever. There is such margin in search, which for us is incremental. For Google, it's not. They have to defend it all. Ed Ludlow on the West Coast with more. Ed, this message is pretty simple. Your margins are opportunity.
Yeah, and it's why the market's watching every single development when it comes to Google's efforts around AI to boost search. The share's down 1%. Adding to the declines we saw yesterday, which was the biggest single-day drop since October. What's so fascinating about this story? The market responded to reports about a video that Google had posted Monday, 48 hours earlier, in which they demonstrated or gave an example of what their AI-powered Bard search could do. In the video, which Google posted themselves, a question was posed, and one of the answers given was inaccurate. We can go over that another time, John, on the specifics. 48 hours later, the media, to be fair, and the market noticed, and there was a severe sell-off in Google shares. The point of it is the intense interest in what this does for the search market. You can see in this Bloomberg terminal chart the complete ramp-up in coverage of stories generated about AI in recent weeks since the start of 2023. The fact of the matter is this: Alphabet and Google dominate anywhere from 80 to 90% of the search market. depending on various third-party data sets. For Bing, Microsoft's search engine, that's around 9%. But they've got first mover advantage. They've played their hand in terms of what their investment in OpenAI and ChatGPT can do to improve their search offering. Now, look at this chart. These seem like spectacular gains. There is some speculative diving in here on anything AI related in the equity markets. One thing I point out to you, John, on those names, which the chart doesn't show, the thing they have in common, they all went public via a SPAC, and they're nowhere near their post-de-SPAC highs. So there is an element of speculation here in the markets around artificial intelligence.
And as Mandeep Singh has said previously, in fact, in the last week, Google quite literally is a verb. How's Microsoft really going to challenge this? I understand the excitement around the story, but it's pretty early days, isn't it?
Yeah, it's interesting. I mean, if you look at the breakdown of Microsoft's financial results from last year, search broadly generated $12 billion of revenue. Most of the street and the market doesn't see actually a huge boost to the top line by investing in Bing. But there is this idea they can claw back some market search. Google is by far and away the dominant player. But as Nadella alluded to, I think what they're fighting over is an increasingly lower margin business where you bring in eyeballs and advertisers based on the competence and the uniqueness of your AI offering. That's what the street's looking at.
Interesting. Ed, you and I are going to talk about this for a long time. Can already see
Can't wait.
Ed Ludlow, thank you, buddy. As always, when was the last time you saw someone like Satya Nadella call out their competition so directly like that? Just absolutely amazing. Alphabet down another 2%, Microsoft up another 1.5%. Your broader market up 0.75% on the S&P, on the Nasdaq up about 1 full percentage point. Tony Dwyer of Canaccord Genuity saying it's too soon to call the recession off, says the following: despite the strong labour market reinforcing the soft landing, the Treasury yield curve and leading indicators have only served to reinforce the recession call. It will take more time to disprove a recession. Tony, I'm pleased to say, good friend of ours, joins us now. Tony, wonderful to have you with us. Here's your line: using a slow cooker in a microwave market. Can you translate that for me?
But I don't even know why you're having me on. All you got to do is chat GPT. What is the market going to do? And then you don't need people.
It's that
like
simple.
Me.
We're all out of a job, Tony.
No, so using a slow cooker in a microwave market, there's times, as you know, John, when the market signals on a very near-term basis can be wrong. We're having 1% moves in the currency markets. We're having big moves in, obviously, the bond market. We've had intraday moves of 1% continually in the stock market. The issue here is there is going to be one side of the trade that is going to be epically wrong in this situation. Either every single macroeconomic indicator that has served to show a recession is going to be wrong this time. Not just the yield curve, not just the Conference Board leading economic indicators. 2 days ago, the Federal Reserve released the Senior Bank Loan Officer Survey. You've never been at this level of tightening credit standards without going into a recession. So unless all of those are wrong, it's just a matter of time before you have enough duration to have the higher interest rates really impact economic output.
Tony, I know you often look to fixed income for some kind of signal to credit and try and understand what it might mean for equity. Credit spreads have been aggressively tighter to start the year. Then in sovereigns, you've got this deep, deep, deep curve inversion, 2s versus 10s, which has dropped to about negative 85 basis point. What kind of signal do you take, Tony, away from what's happening in sovereigns, in the Treasury curve, and what you see take place in corporate credit?
There has been an extraordinary move into risk. So, John, as you know, we'd looked for that fourth quarter rally, the year-end rally, because things had got so pessimistic in October. And we got more defensive in early December when you were up about 13.5% off of that October low. Since that time, you've seen a pretty significant easing in financial conditions. And, you know, when you see the Fed chairman, Jerome Powell, not really push back that hard on, well, there has been an easing in financial conditions, meaning tighter credit spreads, that opens up the availability to money for companies. And that's a good thing. What I find is also a little bit interesting at this point is the new buy signal somehow is we're reducing our workforce. Usually when you're coming out of an economic slowdown, whether it's a soft landing or a recession, you want to have prospects for higher growth. John, my issue here, let's say the macro stuff's totally wrong. There's no recession. You've already made the low. We're at 19.5 times my $210 estimate for this year. Let's say consensus is right. You're at 18.5 times. In a core inflation environment, let's say it comes all the way down to 3 from current 4.5. Where are you going to get the money for growth when money supply has been so negative, and when bank lending standards are the tightest they've been this cycle and in a recession level, when confidence even on an uptick is historically weak, and you're already at full employment? So even if you don't go into recession, where are you going to get the money to have meaningful growth to warrant an 18.5 times very unlikely earnings number?
Well, Tony, tell me where you think is most vulnerable right now. The S&P 500 year to date up 8%. Got the Nasdaq up about 15. We can do some single names. Meta year to date up 54%. Off the lows of January, intraday on Tesla. I can tell you Tesla's now up since those lows by more than 100%. Tony, what's vulnerable here?
Right. I won't speak to an individual stock, but the mega cap tech stocks, when you look at the NDX versus the SPX, it's on a relative basis pretty historically overdone. So I would look for that space to come down. But John, here's an interesting thing. Coming into when we last spoke in December, I think we've spoken since then, but in December, everybody in the universe was loving energy, loving industrials, loving materials, and loving financials. Those areas and not liking tech, those areas when we had said pull back on them were definitely the favorite. They have now given back all the relative performance going back into November. And actually on the energy, you're back to the June relative performance level. So I think we've got to be very careful. And I want to be very clear here. Even if you go back to the low, I don't want to get too bearish. There's a big difference between negative on the economy and where you want to be in the stock market. The problem is if you go back there, it's going to feel so gross and it's going to be so bad that people will accelerate a negative bet. I want to be prepared for when it gets down there. So not overly defensive. I call it being light and tight. Maybe lighten exposure if you're an investment partnership or you have the opportunity to raise cash without a big negative bet, and a little bit defensive because it can all get hit, right? You're going to go down. If you have a recession, the cyclicals are going to get hit on top of the NDX companies that have led. Light and tight sounds like a workout, Tony. You know that. Buddy, I'm a strategist. I'm supposed to do marketing,
Tony Dwyer, Tony, thank you, buddy. It's always good to catch up. It's a difficult moment. Do you really want to stand in front of this? Some of these rallies are so powerful. The move in Tesla, the move in Meta, the move in the Nasdaq. I think being short's one thing, that's expensive. But just getting out and fading the strength, that's what JP Morgan's advocating for. It's what Mislav Matejka said a few times. And some other people suggesting get to the front end. 4.5%, walk away. It's a confusing time. All I can say is, let's look at these numbers, and this rally is looking pretty powerful for tech so far year to date, and it was very unexpected, and that's why I know a lot of you have written in and said this is not about valuations, this is about positioning, it's about flows, it's about short covering, and it is very, very, very powerful to stand in front of. That's the move so far. I want to get you some breaking news that came in at about 10 minutes ago, down in Washington. Anne-Marie has more. Anne-Marie, what have you got?
Hey, Jonathan. Well, it does look like what China says is a research balloon in terms of climate research is inconsistent with the State Department. An official from the State Department briefing reporter says is that this was not that. What the Chinese Liberation Army was doing was collecting data across 40 countries. And what this had capabilities of on this spy balloon was actually being able to collect communication signals. So clearly the United States shot down that balloon, and they are right now doing a lot of that research on what this entails. And they are also doing research and discussing all of this with their allies, Jonathan, because right now what you are seeing is an inconsistency from Beijing, and also the fact this might trouble Xi Jinping because it may make more countries weary of China in terms of their economic policy as well as their intelligence gathering.
AMH, thank you. On the latest in Washington, about 15 minutes into the session, we advance 6 or 0.7% on the S&P. On the Nasdaq, up 0.8%. Credit Suisse down and down hard through most of today. Coming up, Credit Suisse posting a pretty grim quarter.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, to create a new Credit Suisse, much more focused, simpler, built around client needs.
That conversation still ahead.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, which we, as you know, communicated end of October, to create a new Credit Suisse, much more focused, simpler, built around client needs. in the midterm very profitable, and we are executing at pace.
Not inspiring for this stock market. Credit Suisse down 12%. Credit Suisse posting a fifth straight quarterly loss. Clients pulling a record $120 billion as the bank warns of more losses this year. KBW scathing. We expect to see another wave of downgrades and see no reason to own the shares. On the story, Bloomberg's Marion Hoftemeyer joins us now in Zurich. Marion, this doesn't read well at all, does it?
This was horrible. This wasn't just a grim quarter. This is the worst annual loss the bank has had since the great financial crisis. So that really puts into context the dire circumstances they find themselves in. And what's worse, and what was arguably more shocking to investors and analysts, was this huge outflows that you mentioned, $120 billion. That is just phenomenal and unprecedented at this point. And the effect of that is, you know, you have this bank, and you heard Uli Kerner, the CEO, speaking earlier, this bank whose strategy is underpinned by being focused on the wealth business, and that very business is in jeopardy right now.
So, Marion, they've got to hold on to clients. They've also got to hold on to talent. I understand they cut the bonus pool by 50%. They're effectively communicating to their staff there's going to be no profit in 2023. We'll return to profitability in 2024. So who knows what the bonus pool looks like for the current year. Marion, how are they going to keep hold of both clients and talent simultaneously?
That's what makes this coming year so difficult on management, and arguably even more difficult than when they set out this plan in October. They are going to have to really convince clients and their own employees that the upside story is what they want to stick around for. And that means, you know, paying out vested shares that come out later, more upfront cash payments, which is what they've been doing. And for the clients, you know, Uli Kerner hinted, they have been on this nonstop on the phone, talking to every client that they can and trying to get that business back.
Marion, this was brilliant and fantastic coverage all through the morning and the day over in Switzerland. Marion Hoftemeyer there on the story, alongside Francine Lacroix, did a fantastic job with the CEO a little bit earlier on. If you can find that interview on Bloomberg.com or on the Bloomberg terminal, check it out. The job cuts, though, coming through in the finance industry. We're seeing it all over the place now. JP Morgan, AllianceBernstein joining the list of companies cutting jobs. The CEO of AllianceBernstein said this: we expect continued volatility in global financial markets as inflation and interest rates expectations evolve, with related impacts on the economy and corporate earnings. Kaylee has more. Hey, Kaylee.
Yeah, 100 employees being cut globally, firm-wide at AllianceBernstein after they saw a 17% drop in assets under management. So they're trying to reduce their headcount in order to rein in costs as that dynamic unfolds. It's a reminder that even though we've talked ad nauseum about layoffs in the tech sector, it is not limited there. It has spread to finance as well. On the point of JP Morgan, it's hundreds of employees in their mortgage business specifically, which, as we know, has been hit by the slump in housing. Mortgage origination volume slumped 60% for them last year, and we've seen other banks like Wells Fargo making similar cuts to their own respective mortgage businesses, thanks very much to the Fed hiking rates. And we know that other businesses have slowed down for these banks too. So it's not just about the employee headcount. It's also what you're paying those employees and that bonus pool, the conversation you were just having with Marion. Then within the broader finance umbrella, including fintech, look at Affirm, a buy now, pay later company, announcing a 19% cut to its workforce as it grapples with economic uncertainty. That stock is down 13% right now, John, after they missed big and cut their outlook. The CEO saying they need to focus on being leaner as revenue growth slows. So it comes back to the conversation we were having earlier. It is no longer about growth. It's about profit, John.
Is it no longer about New York? Kaylee Lyons, was that it? Is this it?
That was it for
over?
now, John. Yes, I'm heading down to Washington.
Very cool. To do what?
Be talking more about regulation. I'll still be hosting Bloomberg Crypto every Tuesday at 1 p.m. Eastern and doing more exciting work on policies.
Are you going to join us? Are you going to join us still? Can we make that happen?
I would love for that to continue to happen.
Can I just say you've been phenomenal?
Thank you.
I know the audience knows how early you wake up, but you still jump into that seat to join us and help guide us all through these markets, and we appreciate it. Kaylee, just fantastic, and I know you're going to go on to fantastic things down in DC as well.
Thank you, John.
Kaylee, thank you. Coming up, the market moving events you need to know. That'll be next in our Trading Diary. 25 minutes into the session, we advanced by 6 or 0.7% on the S&P, up almost 1 full percentage point on the Nasdaq. That's the price action. Let's get you the Trading Diary. Coming up, President Biden discusses healthcare at 1:30 Eastern Time. Lyft reporting results after the closing bell. Uber numbers earlier this week, pretty decent. More Fed speak coming from Waller Harker on Friday. And then the UMich Consumer Sentiment Survey to close out the week and get you to the weekend. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. We'll get you to the weekend tomorrow and look ahead to CPI and on Valentine's Day. That's the next big stop for this market. This market so far, though, looking pretty decent. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.